A very good morning, guys. I hope that you are doing well. I've actually decided to make this video for the morning Zoom meeting that we actually missed yesterday. This is actually a management accounting meeting where we'll be discussing the concept of the cost of capital. Okay, we started the other day. We discussed more in detail the company's decision with regard to the decision to actually invest and the decision that a company will take to finance. Okay, now in terms of the investment decision, we mentioned the fact that a company will have a capital budgeting and evaluation aspect to consider. Once we have actually decided on what assets we are going to invest in, we'll then have to decide as to how we are going to finance those particular assets. Okay? Which is basically the very, very important question that we need to ask ourselves within an entity. The way in which we are going to finance it could either be debt, or we can either use equity. The other way in which we can actually finance our investment decisions, we can actually use the combination of debt and equity. We talked about that quite a lot in our first session. We in fact even we went to a greater extent by actually discussing the concept of a net present value and how do we go about determining the net present value of a project in line with capital budgeting. Okay, so what we will be looking at in more detail this year is the computation of the required return on an investment using this concept of the weighted average cost of capital. Okay, so we can calculate this weighted average cost of capital at a market value. We can calculate it using a bulk value, the target value, which is actually used to decide as to whether we're going to accept the project or we're going to reject the project. Okay, now in terms of the financing decision, so the financing decision for a project, we use it to decide as whether we're going to use the combination of the debt or the equity or both debt and equity. We have to understand as to how then we're going to go about financing our investment in assets. It's very important to know what financing structure are we going to use. If we're talking about debt financing, I mentioned the fact that we use KD. If we're talking about equity financing, we calculate the value of KE, cost of equity. Okay. Now, what are examples of debt? Examples of debt will be debentures. Now, I want to talk about debentures more in detail today. I know that I discussed the debentures the other day, but let me just take you through the concept of debentures. Okay. Now, debentures or a debenture in perpetuity actually has no sort of redemption date and will tend to continue indefinitely to pay the respective interest at a coupon rate. Those debentures are actually known as non-redeemable bonds or notes. Okay, I'll make a simple example. Okay, an example will be if you have a non-redeemable bond that actually has a face value of 100 and pays a respective coupon rate of a 15% per annum. Now the current market rate for a similar bond is actually 9%. Now the question which we should ask ourselves is to what will be the respective value of the bond. It is clearly not the 100 rand. Okay, so we will be receiving a 15 rand every year from this particular debenture. Now, how did I get the 15 rand? If you take the 100 rand being the face value of the non-redeemable bond and you apply the coupon rate of 15%, you'll get a 15 rand, and which you should be receiving every year. what you should be getting a 9 rand. How did I get a 9 rand? We were told that the current market rate for a similar bond is at a 9%. So if you take a 100 rand and you apply the 9% on it, you will be getting a 9 rand, which means that the required return may actually be said to be at a 9%. So if you want to get the present value of the amount that is going to be received in perpetuity, it can actually be calculated by capitalizing the return received at the required return. Okay, so that means that the value of the bond will actually be, if you take the 15 rand that you'll be receiving in a form of some sort of a contractual inflows, dividing by a 9%, you'll get the value of the bond being sitting at a 166 rand, 67. So in a nutshell, what we're going through is the valuation of the bond in perpetuity. But we'll deal more with valuation a bit later. What I wanted to take you through is just the definition and an understanding of our debentures and bond in perpetuity. Another thing which you need to understand is that the first class of a bond that I dealt with was some sort of a non-redeemable bond or a debenture. What if we are dealing with redeemable debentures and bond? Okay, in a situation whereby we are dealing with redeemable debentures and bond, a redeemable debenture actually have a maturity date on which a redemption will actually take place. Let me repeat this. This is very, very important. If we are dealing with a redeemable debenture and a bond, a redeemable debenture will actually have a maturity date on which the redemption will take place, which means that it cannot therefore be capitalized into perpetuity. Okay, so you notice in a situation where we were dealing with some sort of a non-redeemable bond, what we did is, to get the present value of the amount that will be received in perpetuity, we calculated it by capitalizing the return received at the required return. With respect to redeemable debentures, what happened is, since it has some sort of a maturity date on which the redemption will actually take place, therefore we cannot capitalize into perpetuity. Okay, so there's two sort of different types of cash flows that are involved in a process of valuing a redeemable debenture. Okay, so the first sort of cash flow will be the one in which we deal with the periodic interest payment, and the second part of it will be the repayment of the capital at the date of redemption. So those are two important sort of steps or types of cash flows that are involved when we are dealing with the valuing of a redeemable debenture or the bond. You need to understand this, and you need to know this in detail. So the way in which we calculate the value of the redeemable bond or a debenture, it will be, we use VD, means the value of the debenture, which is equal to the sum of our, if you take your respective coupon payment per period divided by 1 plus R to the power of T plus the P into 1 plus the value of R to the power of N. Now the R is standing for the required rate of return, and the N is standing for the number of period. The I is standing for our coupon payment per period, and the P is our redemption of our principal amount. So this is the formulae which we use to actually determine that value of our debenture or of our debt. Okay, now you have to understand this. If you are dealing with a situation whereby you are given a price for a bond or a debenture, then the internal rate or the discount rate that makes the formula that I've actually articulated valid will be the yield to maturity. Okay, Now, this is actually the same as the internal rate of return that we covered in financial accounting, okay? We can actually use the internal rate of return function on most of the financial calculators to actually determine a bond yield to maturity. So you actually need to understand all these key principles so that you won't have the problem when you're dealing with the valuation of a redeemable debenture, okay? Now, let me talk about preference shares a bit. So, if you're dealing with a debenture holder that receives some sort of a fixed interest payment each period, now you'll know that there will be a sort of options that may be present when you're dealing with preference shares. There are those that are convertible, there are those which are not convertible. So you need to understand these concepts greatly so that you don't have problem when you're dealing with testing exams. When you're dealing with a preference share that actually receives some sort of a fixed interest payment each period, the preference shareholders that are receiving a fixed dividend payment will actually be regarded as a debt, sort of a preference share that will be held by an entity. But if you are dealing with a preference share that is receiving this sort of dividend payments, and at a later stage you are being told that there's some sort of a conversion option, what you will then have to consider is that what was held as a sort of a debt, sort of a financing, will then be converted and become an equity financing in a form of ordinary shares or ordinary sort of shares. Yes. Now, the company is actually not obliged to pay a dividend, and the respective dividend payment may only take place after we have made the payment of the relevant expenses within an entity. So these expenses that will include things like interest, which are paid prior to the distribution of dividends. Okay. Now, the preference shares, they can either take a form of being accumulative or non-cumulative. Now, why am I taking you through this important sort of descriptions and definitions? I want you to understand the basics, the foundations as to how then will you deal with calculating the cost of equity using our dividend growth model. How then can you calculate, for example, the value of the preference shares if you are dealing with the cost of capital or work? Okay, you need to understand first what do we mean by preference shares that are cumulative, what do we mean by preference shares that are non-cumulative. Now, in terms of when we're dealing with the preference shares that are accumulative, what we talk about is in terms of the dividends that might be in arrears. They may either be at an option of being redeemable or non-redeemable. Okay, so some preference shares are actually convertible into ordinary shares, as I've mentioned earlier, and you'll find that the classification of preference shares, some of them they are classified as participating, and some may actually be not classified as participating. But you will be told the specifications in line with the respective question that you are dealing with. Okay. Now, what if we are dealing with a cumulative non-redeemable preference share? Okay. Now, the value of the preference share is actually the present value of an annuity that will be received in perpetuity if you are dealing with a situation of a cumulative non-redeemable preference share. Okay. Now, I'm going to make a simple example that you will understand and appreciate. Now, let's say we are dealing with a person here who would like to actually sell 100 preference shares. Now, these shares actually have an issue price of a 1 rand, and they carry some sort of a dividend of 10%. Now, similar shares that are available on the stock exchange, they yield an 8% dividend. Now, what is the value of the preference share? That's a question that you might want to ask yourself in line with valuing these preference shares and putting value to them. We'll see, we will be discussing this most in terms of valuation. But what I'm taking you through is the background understanding of the key terms in line with the cost of capital. Because you will see, I talked about KD the other day in terms, I talk about the dividend growth model, which I'll be going through it again in detail so that you'll remember what we covered. Okay? Now, in this example, what you will see that in the amount of our annual dividend, which is actually sitting at the value, if you take the 100 shares, I'm being told that we have 100 shares that are preference shares that are disposed here, and the dividend is actually paid at a 10% rate. So if you take the 100 times the 10%, and find that we will actually be receiving a 10 rand. So the capitalization rate will actually be the required return, which is given to us at a 8%. So if you want to find the present value of the share, of the preference share, you'll have to take the 10 rand, bring in a dividend payment, divide by the required return of 8%, which will give us the 125. So you'll notice that the value of these preference shares, they actually depend on the future returns, not actually on the issue price. Okay, so the preference shares have actually a right to dividend distribution after we've actually paid for the relevant expenditures that are needed to be met by an entity. Okay, now there will be times where an entity is faced with a situation whereby there is insufficient cash or resources that will be available to meet the obligation with respect to preference shareholders, and under those circumstances the entity will not be able to make payments for dividends. Okay, so this means that the dividend is actually said to have passed. Okay, now if the preference shares are cumulative, what that means is that the dividend owing for the previous years have to be made good before the company can distribute any dividend to its ordinary shareholders. So in such cases, it actually is necessary to estimate the area dividend that will be received and to discount those to a present value sort of a term using the required rate of return. Okay. Now, similarly, if there is some sort of an expectation that the future dividend may fall into arrears, the date of receipt of those dividends must also be estimated as a result. Okay, so that's very important for you to take into consideration if you are dealing with cumulative preference sheets at all times. Okay. Now let me talk about non-cumulative preference shares. Okay, let me talk about non-cumulative preference shares. So a non-cumulative preference share, it simply actually involves the valuation of dividends only. Okay, so what you need to consider here is as to whether the dividend is likely to be passed in the future or not. Now, if it is more likely than not that the dividend will be passed, that means that the preference share will be less, or sort of will be worth less. Okay, now why will it be worth less? It will be worth less due to the fact that there will be no cash flow in the certain years to come. Okay, so it's some of the things that you'll have to consider and understand and know when you're dealing with the non-cumulative preference shares. The concept of the redeemable preference shares. Now, in terms of valuation of our redeemable preference shares, it is actually similar to the redeemable debentures. Now, there is a problem here, and the issue is in valuing the redeemable preference share is that there will be sort of instances when they may be redeemed only to the option of the company. Okay, so in carrying out such evaluation, it has to be necessary to assess the likelihood of the redemption on a particular date, And if the coupon interest rate is actually higher than the current market interest, then the likelihood will be that the redemption will actually take place. Okay, so I want you to know these simple details and to understand them, and to please just go through this record one or twice and make sure that you understand it nicely in line with the things that I've mentioned. Okay, because it really is very important to understand your sort of theory in terms of definitions, because once you understand definitions, you won't have the problem in terms of dealing with calculations. Okay, now let me talk about this sort of financing in an equity sort of an investment. I mentioned the other day that the ordinary share valuation, it's actually difficult sometimes to determine this value due to the level of uncertainty regarding the future cash flows. In terms of future dividends, the earning will depend. I mentioned the fact that it will depend to things such as the state of the economy, the interest rates, and the forex fluctuations that might affect this valuation of our equity. Okay, and also some of the things that you might take into consideration is that the ordinary share will tend to be an indefinite life. It's have an indefinite life, which means that the investment is actually forever, as the share actually have no sort of a maturity date at which it can actually redeem. Okay, so the rate of the return that is required on the market is actually not known when you are dealing with the valuation of our ordinary share. Okay, so it's some of the things that you'll have to take into consideration. I mentioned the fact that the other day the value of the share is actually the present value of all our cash flow that will derive from that particular share in terms of being an ordinary share that we are holding. Okay, so there will always be uncertainty around the payment of dividends. Okay, an entity might not know as whether it will be paying higher dividends in the nearby future or lower dividends. It will depend on the situation. So as I've mentioned, in terms of when you're dealing with shares like our ordinary shares, they have no maturity. Okay, so there's no maturity as long as the company is existing. There's no sort of maturity as to when or as to how we're going to derive the cash flow. There's a lot of uncertainty that exists around it. Okay, so the key question that you should be asking yourself is to as to how do we establish the future cash flows of an ordinary share. Okay, now, because we don't know what the future dividends are going to be, we have to make certain assumptions that will enable us to determine the value of our shares, okay, of our ordinary shares. Okay, so what we use is what is called the dividend growth model. So in line with the dividend growth model, to calculate the present value of our ordinary shares, we use P naught, or we use the formula in line with the dividend growth model. P naught is equal to D1 divided by KA minus G. Okay, now P naught is actually the current share price at time naught. Okay, so it's actually the present value. Okay, and D1 is the next dividend, which means that if I'm talking about D1 will actually be D naught into 1 plus G. Okay, the little g is actually our dividend growth rate. Okay, now KA is actually the cost of equity or our shareholders' required return in line with the capital asset pricing model. Or we can use the capital asset pricing model to determine the KE if you are not given. So just know, if you're not given KE, it doesn't necessarily mean that you won't be able to calculate it. You can calculate it using the capital asset pricing model. As I've said, G is the growth rate. Okay, now the dividend have to be growing, however, at the constant sort of an amount from 1 year to the next, forever and ever into perpetuity, because the shares are actually being held in a, or they contain, or they have some sort of an indefinite life, since there is no maturity. One of the things that you need to note, you have to be careful of which dividend you're actually using, okay? Because sometimes you might be given D1, and then all of a sudden you start calculating D1 using D naught into 1 plus G, and your calculation might be wrong as a result, okay? Now, there's sort of key assumptions and limitation that are in line with the dividend growth model. Okay, so the dividend growth model, what it assumes is, it actually assumes that the dividend growth is actually constant. Okay, so if you're dealing with, if the dividend growth is not constant, then you can't utilize the model. And also the dividend growth rates can actually be forecasted, and all the shareholders will have a similar expectation about what to derive from their investment. Okay, now the other day I talked about this sort of an assumption that the KE, being the required return, have to be greater than the growth rate, being the little g, okay, the growth rate. Now, one of the things that you need to understand is that when we are going through the calculation, okay, it have to be greater than your G, being the growth rate. Okay, so it's some of the things that you need to take into consideration. Now, you remember the other day we went into a very detailed example that we looked at. Now, if the ordinary share have a zero growth, or some sort of a zero growth in dividends, okay, what you're expecting is, you are expecting the dividend to actually remain at the fixed level, then the value of the equity will actually be the present value of the perpetuity. Okay, some of the things that you will have to think of and actually deal with if you come across a situation whereby you are presented with such information. Okay, now what you could actually get is a question where you might be dealing with some sort of a non-constant growth in dividends. Okay, in few years, and you'll find that later it cycles to some sort of a constant growth and dividends. Under those circumstances, you'll find that you will be presented, or you'll be furnished with an information and some sort of a historical data in terms of the distribution of dividends, and then thereafter they might tell you that after a certain period of years, then the dividend started to grow at a particular rate, and you might be given the required return. Then you'll have to go about finding the discount factors for those respective years in terms of the historical dividends that you will be given, and then use thereafter the required rate of return to predict the distribution of dividends and the present value of the shares that you are dealing with. Okay, so very, very important that you understand it and you go through it. Okay, the other day I talked about more in terms of the cost of debt, and you will see that in our next session, in the next session that I will upload, I will be discussing more concepts in line with the preference share computation, the flotation cost. Just make sure that you listen to the next video that I will be uploading, because I'll be explaining quite a number of things in detail. For now, just take care and continue studying and working hard, because the assessments are around the corner and they are a bit challenging. So cost of capital, very, very important. Please go through this at least 3 times so that it may sink in. I will then be going through more, or I'll be going in depth in terms of the part 2 video that I will be uploading. For now, take care and bye.